Hi guys, I've noticed a few trends on the back of the tax reform and the budget changes, and I wanted to go through them with you. We'll go through essentially three trends that I'm seeing and just a few risks and things to keep an eye out for if you are considering these trends. Now, these are essentially strategies that people are considering doing now that the tax treatment isn't so favorable for residential investment property because of negative gearing, removal, new purchases of existing property, removal of the 50% CGT discount, and now the removal of self-managed super funds being able to use a limited recourse borrowing arrangement to purchase residential investment property. So that being said, let's kick on. The first one is the trend I'm seeing of investors using the strategy to purchase commercial property because negative gearing still applies to commercial property. And I just wanted to caution people a little bit around purchasing commercial property, especially those that are somewhat novice investors. They don't have the education or experience associated with purchasing commercial property. There's a few things that I strongly feel that you need to consider. The first one is holding commercial property is a little bit more cumbersome. You need to negotiate lease agreements. The expenses aren't always as straightforward. It's depending on the lease agreement. The vacancy rate can be typically longer between tenants. Yes, the rental yield is great, but it's a little bit more cumbersome to manage a commercial property. The other thing is as well is that vacancy rates are typically longer and your commercial property is a little bit more susceptible to the economy. And that's because businesses occupy commercial property. So that being said, if the economy is not doing so great, then your property might be without a tenant for longer, or you may need to reduce your rent, or the capital value of the property may be reduced. If you do have a tenant in place and the economy isn't doing so well, then one thing that might need to happen is that you may need to offer your tenant some reprieve in the form of either a reduced rent or catch-up options or something along those lines. We saw this a lot during COVID, where some landlords were asked to provide their tenants some reprieve. And the third item around commercial property is the purchase process. The purchase process is relatively cumbersome. It's not essentially straightforward. Sometimes GST is applicable. I'd strongly recommend that you get a commercial property manager to look at the property with you and the contract, get your conveyancer or also look at the contract definitely, and really get an understanding of the process associated with purchasing commercial property. One other thing I might add as well is around the type of commercial asset. Your commercial property needs to match the requirement of the area, and that's because there's many types of commercial properties, whether it be an industrial warehouse, whether it be office space, whether it be a retail shop front, whether it be a storage unit, whatever. It needs to match the demographic of the area. And for that reason, you need to select your commercial asset carefully. So that being said, it's somewhat cumbersome. I wouldn't enter into a commercial property lightly. The second trend I'm seeing is people buying off the plan apartments or house and land packages. Now, big caveat, I'm not the biggest fan of these types of assets for a couple of different reasons that I'll go through. The first issue is these properties are generally more expensive for a few different reasons. First reason is because construction costs are high because of trade shortage and the cost of materials. Second reason why they're expensive is because the holding costs associated with this property while approval is sought out. And the third reason why these types of properties are so expensive is because all of the inbuilt commissions and marketing costs associated with these properties. The other issue I'm finding with these type of properties is the quality of them. And we've seen a lot around off the plan apartments, especially high-rise apartments. The quality of these properties typically isn't the greatest. And as a result, we've seen the rise of remedial building works over the last 10 to 20 years. So that being said, I'm not a big fan of the cost and the quality associated with new house and land packages or off the plan apartments. In addition, I feel that investors will have trouble selling these properties because once you purchase a new house and land package or off the plan apartment, yes, you do get your negative gearing incentive and 50% CGT discount. However, the next purchaser doesn't receive the same benefit. And that's because the property ceases to be new and becomes an existing property. So that being said, what is the incentive to buy a new property if the subsequent purchaser doesn't receive the same benefit? And the short answer is that there isn't really. And more than likely what will happen and what we've seen happen is that off the plan apartments especially devalue because of the overwhelming supply of properties, especially in high-rise areas. Now, I live in Sydney, so I notice in Sydney's inner west, Ashfield especially, I notice it in Gladesville, I noticed in Ryde, Epping, Macquarie Park, Alexandria, Zetland, that there are a ton, Mascot as well, of high-rise apartments. And the overwhelming supply of these apartments dilutes any demand, and therefore this puts downward pressure on property prices. In addition, your average house and land package is typically built on the fringes of your cities, and these areas have similar supply issues. They have overwhelming supply in a concentrated area. In addition, they don't have the infrastructure associated with some of the existing suburbs and things like train stations, shopping centers, schools. And so you're faced with the need to commute into those areas, work, wherever. So that being said, there may be a little bit of dampener on demand for those areas. So I think that is the biggest reason why you really need to consider those aspects of house and land package and off the plan apartments. The third trend that I'm seeing in terms of property strategy is people investing overseas. Now, I have heard of people buying in New Zealand, buying in Bali, buying in Europe, buying in America, or at least considering it. And one of the biggest things that I want to caution people around purchasing overseas or even just investing overseas is the biggest risk that they will have is currency risk. And that is the risk that the exchange rate will fluctuate. So even if the value of your investment doesn't move in that local currency, the exchange rate may differ, and you could really magnify any losses as a result of exchange rate risk. In addition, there's all sorts of red tape associated with purchasing overseas. You may be susceptible to foreign tax, much like is applicable here in Australia. So that being said, it's a bit of a legal and tax minefield associated with purchasing property overseas or investing in property overseas. So look, that being said, I just wanted to go through these items and warn people more than anything around purchasing property in those three trends that I'm seeing. I'd really speak to financial services professional, legal professional, if you're thinking commercial property manager, and just get some independent advice around if this strategy is applicable to your financial situation and your goals. Thank you everybody for watching. I hope you've taken something away from this video, and I'll see you in the next one. Thanks again.